So this whole space of private credit has been blowing up. Like traditionally,
Yeah,
debt meant banks and
right.
equity meant private players like private equity, VCs,
Right.
which now I think more and more banks are kind of giving up that space of debt to private credit players. Why is that happening? Like, why
So
are banks
banks,
getting crowded out of this?
no. I think that's not correct. The banks are not giving up the space of debt. What's happening is, if you look at a company, right, and you look at the capital structure of the company, right, the highest risk is the equity, because the equity is basically equity risk, right? It's basically your money which has gone in to start the company or what have you, right? And the lowest risk is bank credit, because the bank is taking the security of all that is there. The bank is giving you money which is working capital money, etc., all of those right things. There is a sliver in between equity and debt, which could either have a look like equity but is not completely equity, may look like debt but it's not completely debt. That is the space where private credit is playing in. So I actually think of private credit as a mezzanine solution between equity and debt, because a private credit player will never be able to compete with a bank on financing for pure debt. Simple debt, you want to take a mortgage loan, right? Mortgage loan is available to you at 8.35, 8.5% in India. How can a private credit player ever compete with that? Banks do get deposits that they're getting at 4, 5%, 6%, which is consumer deposits. People like you and I giving money, they're able to use that money and lend it out at 8, 9, 10%. We will never be, no private credit player will ever be able to compete with the bank in that space. What's happening is that people aren't giving up spaces, people are getting slotted into where they have their strengths. Banks have their strength in what we call senior lending, which is the senior lending stack on a capital structure, which is the least risky capital stack in a structure. Why? Because they have the best security on the company's performance, right? And then the equity guys have no security, because equity risk is full equity risk, right? If the company goes under, the senior guys are the first guys that will get paid. So if you liquidate a company because the company's cash flows didn't come in, and then you went through the whole bankruptcy proceedings, whatever is left, the first people to get paid are going to be, apart from the government and labor and all of that, those things I'm keeping out of it. I'm talking about financial creditors. The first people who will get paid are going to be the banks, right? Then they're going to be the mezzanine guys, and then it's going to be the equity guys. So the private credit is operating in the mezzanine, and by the way, the return expectations also changes accordingly, because risk and return have to play a game out here, right? So when the senior credit in India, and I'm talking about rupee loans now, rupee loans are anywhere between 9 to 11%, 9 to 12%. That is what is the senior credit category. You come to the mezzanine category is between 12 to 16, 12 to 18%. And the private equity guys are trying to solve for 20 to 25% return. So that's really how the cookie crumbles. Losses are zero,
Amazing.
right?